All right, good morning, everyone. I believe we can all hear me. Welcome to our webinar on the new IFRS 18. It's a standard that may seem like a basic standard because it's replacing IAS 1, but this introduces a lot of changes to how we prepare and present financials. So it's not just relevant to accountants. Typically, you think that when an accounting standard changes, only accountants or preparers of financials should care. But this is a standard that affects everybody. As long as you're a user of financial statements, whether you are an analyst, you are a journalist picking numbers from financial statements, you are a data analyst, you use numbers to create insights for management, you need to know what IFRS 18 is changing because the things that would appear on financial statements mandatorily will change, right? So this is a very important standard that I believe everyone should have a good working knowledge of. So that is the purpose of this webinar. We will talk about what is changing regarding IFRS 18. My name is Michael, and I'll be your host for today's webinar. If there are any questions, you can use the hand raise button, and then you could type a comment as well. But please try not to unmute your microphone if you have not been given the permission to. Thank you. All right, so before we start, if it's the first time coming across MSL Business School, we are social, so you can connect with us on all our social media platforms, YouTube, LinkedIn, Facebook, TikTok, X, formerly Twitter, and then Instagram. So you can give us a follow, and then you probably see further events and webinars from us that you can join to get better technically as an accountant, finance person, or anyone just interested in numbers, right? We'll have an upcoming one on taxes, so please follow us on social media so you don't miss out on our next update. So what is the agenda for today? What's the plan? Like, why are we here, right? So we are discussing IFRS 18, obviously. So what do we want to do today? First thing is we'll talk about an overview of the changes introduced by IFRS 18. It's introduced so many changes. So we'll start by looking at a very high level view of what those changes are. We'll look at the new income statement. And I like to call it a new income statement because it is new, right? The income statement as we know it would look different once this standard is implemented. Then we'll look at what we call the non-GAAP measures and MPMs, that's management defined performance measures. These are also new things that a standard requires preparers of financial statement to include in their financials. Then it will amaze you to know this standard has gone to affect other standards. So we'll see changes affecting, for example, IAS 7 on the cash flow statement. We'll see changes impacting IAS 33 on earnings per share. We'll see changes even impacting what? IAS 8. So IAS 8 that we currently call accounting policies, change in estimates and errors, has had a change of name because of IFRS 18, right? So we'll see what kind of impacts this will have on other standards. And then I'll talk about getting ready for IFRS 18, your implementation, how do you get ready, how do you transition to this new standard, and then we'll take any questions that you may have. Sounds like a good plan, right? So let's start an overview of the changes introduced by IFRS 18. But you cannot talk about the changes if you don't know the why. Do you understand, right? Why did we have to change IAS 1? Someone might think IAS 1 served us well, right? Right when I was an accounting student all the way to now, we've been using IAS 1 on presentation of financial statements. So why did we have to change IAS 1? We saw so many standards change. We saw the new lease standard IFRS 16 changing the old IAS 17. We saw IFRS 15 on revenue changing the old IAS 18. So like those were topical issues. We were like, probably we needed those, but did we have to change our presentation standard? And the answer is yes. There were some issues that both the users and the preparers of financial statements brought up. More importantly, came from the angle of the users, because the users use the financial statements to make decisions, right? So if they are unable to make decisions using financials, then we need to present financials in a way that makes it easy for them to make their decisions. So the first issue that was identified is we had no IFRS defined subtotals between revenue and profit or loss. Pick the P&L, or the income statement as it's properly called, and then you look at revenue all the way to profit or loss. We did not have specifically defined subtotals, right? So Companies calculated their subtotals in different ways. In fact, in a sample by the IASB, they took 100 companies. They found that 63 of those companies reported just the expression operating profit using 9 different definitions at least. So it means you take company A, what they call operating profit in their P&L is different from what company B calls operating profit. The expression is still operating profit, but what goes into that operating profit line was different. And one of the qualitative characteristics of financial information is that there should be comparability. I should be able to pick company A's financials and compare to company B's financials, right? So this stopped comparability being a possibility, because if 3 companies, in fact, if I took 10 companies, and if, let's say, 5 of them, 6 of them had different definitions for operating profit, then what really was operating profit? What did they add to that figure to get operating profit, right? So there had to be something done. So going into details on this, another issue they identified was, even for those of us who are accountants, under IAS 28, we use the equity accounting method to account for what? Associates and then joint ventures, right? So even that accounting for the share of profit of that associate or joint venture under IAS 28, some of them included it in operating profit, some did not. So those who said yes were 28%. So it means for some people, the share of profit or loss from an associate or joint venture was an operating profit. For others, it was not. Meaning, once again, that you pick the operating profit line, and then for 2 different entities, one will have share of profit of associate or joint venture in there, the other will not. Once again, creating a comparability issue. Also, let's go to IAS 19 on employee benefits. So there are some elements that go to P&L, right? One of them is interest cost on defined benefit pension obligations, right? So some also included them in operating profit, some did not. So 25% said yes, 52% said no, 23% were not sure where to put it. So it depended on how they felt in a particular year. Once again, comparability was an issue. So we had to bring a standard that made it clear that put this here, put that here. I hope we understand. So we are starting from, before we see what the changes are, what were the issues, what were the challenges? It gives you a better appreciation of the standard. So this is the first set of issues. Then, as if that was not enough, many companies also provide what we call performance measures defined by management. So when you are communicating with investors want to see different measures. Companies had different measures that they were presenting to their investors. And there was no, once again, consistency in those definitions. So investors have said the measures provide useful information, but it should be in a more transparent and disciplined way. If you want to define a particular expression, make it clear that this is what it means and this is what goes into computing it, so that, for example, these are some common management-defined performance measures many companies put in their annual reports. Some will have a line called adjusted profit. Some will have adjusted operating profit. Some will have adjusted EBITDA, which is earnings before interest, tax, depreciation, amortization. And some have adjusted EBIT, earnings before interest and taxes. So these different measures we have here, we had different financial statements showing these different definitions. The question the investors were asking, or the users were asking, okay, how do I know company A's adjusted EBITDA is the same as company B's adjusted EBITDA? In fact, companies could present financials in a way that told a particular story, because they'll probably exclude something from EBITDA, so the EBITDA looks better than it's supposed to be, right? So we had to find a way to say, okay, there should be some management-defined performance measures that will be subject to audit. So we'll come to that. Auditors will now look at those numbers and then express an opinion as to their presentation, right? Then for some who use those particular measures, did they provide a reconciliation? Because IFRS has its specific requirements and disclosures, right? So 70% said yes, they reconciled their own management-defined performance measures to IFRS, but they had little or no information on the tax impact of those. 19% said yes, we disclosed with detailed tax effects. 11% said no. So it meant we needed a clearly stated provision on how to treat this, and IFRS 18 has covered this as well, right? Still on the challenges or the issues. When we come to the cash flow statement, the classification and presentation options in the cash flow statement made it difficult to compare companies' cash flows, right? A lot of things have changed when it comes to the cash flow statement because people were putting whatever they wanted to put anywhere they wanted to put it. There had to be a way to make the cash flow statement a standardized financial statement. So what happened here? So the starting point for the indirect method has changed. So on the IAS 7, we have the direct method and the indirect method, right? So for indirect method, you start with your profit before tax. For many companies, some will start with their profit after tax. They said, you know what, hold on. Everybody's starting point, before we come to that, some were using profit or loss, 41%. Some used profit before tax, 32%. Some used operating profit, 11%. Some used other subtotals. So it meant that reconciliation and the operating activity cash flows had different starting points. The requirement now is everybody will start from operating profit. We'll come to that. But you can see the diversity of practice here. People were doing different things, right? Then even the classification of interest and dividends, it was all over the place, right? So you can see here that for 56% of people, they put interest received under operating activities. 30% said it's investing activities. In fact, you had 3% who put under financing, interest received, which I hadn't heard of before, right? But this is a survey they did for companies. Then interest paid, 59% said it was operating activity cash flow in their financials. Then we had 34% saying they didn't have an idea, it was unclear, which is really true. Dividend received, we had what operating activities having the majority. I mean, it goes on and on and on. This also, we've seen a lot of clarity here. So we've been told specifically where to put certain items. Now, this takes us to, if you know how the US GAAP works, that's the US accounting standard, we are now leaning more towards so they have a rules-based jurisdiction, whereas IFRS is more principles-based. But because of all of these uncertainties, right, we've seen our move towards a slightly rules-based approach because you are told, okay, put this guy here. You don't have the freedom as to where to put certain items on the cash flow statement. So I'll come to that into a lot of detail, right? Okay, so enough of the challenges. Enough of the issues. What are the changes introduced by IFRS 18? At a very high level, we'll go into detail. The first one is it replaces IAS 1, which is the presentation of financial statement standard. So IAS 1 will die and IFRS 18 will take over. First point, right? Next one is we have new presentation and disclosure requirements under the standard. The next is IAS 1 did not die complete. I mean, it will die, it will get buried, but we brought a lot of requirements forward from IAS 1 with limited word changes. So we didn't create an entirely new standard. We had the old one, brought forward a lot of changes, took the relevant ones, and then killed IAS 1, right? Okay. IFRS 18 will not change how companies recognize and measure items in the financials. Far from it. IAS 16 will still be your standard on PPE. IAS 42 will still be your investment property standard, right? IAS 36 will still deal with impairment. The standards that currently govern different items on the financials will still be those same standards. It just comes to give certainty as to how you should present generally the financial statement. So it won't change the fact that, for example, IAS 16 tells you that under the revaluation model, take a revaluation gains to revaluation surplus under components of equity, right? It doesn't come to change how accounting is done. It just comes to put a lot of clarity around how the numbers are presented, right? So it doesn't change or override any particular standard. Let's have that clarified. It also amends other standards, including IAS 7 and a few others I mentioned at the start. We'll see them into a lot of detail. It is effective when? Probably wondering, 1st January 2027. It becomes mandatory, but as usual, early application is permitted, right? And we'll come to the implementation. This one needs retrospective application. So you can't just say, I'm applying IFRS 18, it will affect something else, right? So it's something that companies need to assess carefully, right? Probably going to increase your audit fee a little bit that year, but I mean, it's still worth it, right? And then it's applied retrospectively, as well as in your interim financial statements as well. So it has implications, not just on your annual financials, but also on your interim financial statements, right? Okay. So still at a very high level, We have new subtotals. I'll talk about them. Operating profit and what I call PBFT. We'll see that. Income and expenses are now classified in 3 categories. So on the face of the P&L, we have 3 main categories for both income and expenses: operating, investing, financing. Do not confuse this with the cash flow statement 3 categories. They are not the same, right? But just know that the P&L also now has 3 categories: operating, investing, and financing. Then there's something we're going to call the MBA, or the main business activities, right? So your MBAs will now drive the classification of income and expense. So based on what your MBA is, we'll get to know whether something is operating, investing, or financing. I'll talk about that shortly. Then MPMs, that's management defined performance measures, are now disclosed in the financial statement, and they are subject to audit. If you disclose them, it means the user may rely on that information. So your auditor should provide an opinion on that as well, right? So that is to know. Then these MPMs capture some, but not all non-GAAP measures. So not every management defined performance measure is an MPM under IFRS 18. I'll talk about that as well. And then we now have enhanced requirements on grouping of information. What can you aggregate together? What should be disaggregated from one another, right? We'll see all of those things as well. Then the cash flow statement has seen a change. The balance sheet has seen a change, right? So we'll come to that as well. Then, like I said, effective date is 1st January 2027, right? So we'll come to all of these things. So this is an overview at a glance. If you want to just know what is changing, these are the high-level issues, right? But there's a lot more detail to this, as I'm sure you are suspecting. So let's start. The new income statement. What is changing here? And what's the big deal, right? Why do we call it a new income statement in the first place? So for this, first thing is, like I said, there are going to be 2 new required subtotals. So I'll take my time here because it's very important, right? If you don't know anything at all about IFRS 18, these are things you should know, right? So there are going to be 2 new required subtotals. You need operating profit and you need profit before financing and income taxes, mandatory. Operating profit and then profit before financing and income tax, right? So if you look here, you see we clearly have, this is what our operating profit line, and then we have our profit before finance and income taxes here. You must disclose these, right? Subtotals. All right. Then we have 3 new categories for our income and expenses as well. So we have operating income and expenses, investing income and expenses, and financing income and expenses, right? So these are also 3 new categories for both income and our expense. I mentioned that this is not the same as the categorization we already had in our cash flow statement. So result of equity accounted investees. So you go to IAS 28, your associates, your joint ventures that you account for using the equity accounting method. Their results are no longer presented as part of operating profit. They are in investing now. So we spoke about the issues that were persisting before the standard came in. So one of the issues was this, right? So where do we put the result of investment in associates and joint ventures? Now it is clear. Put everything under investing. So if you come to investing here, share of profit or loss of associates and joint ventures are now investing activities, not operating. You don't have that freedom as to where to put it now. They are now investing activity not cash flows on the P&L, right? Early on the investing activity part of the P&L, right? Okay. What else are we supposed to know here? Like I said here, this is not aligned with the cash flow statement. So please, let's be mindful of that, right? The next thing we need to know is, I mentioned operating, investing, financing. What goes into each of these 3 headings? So let's start with income and expenses, right? So operating category, you put here all income and expense from a company's operations, regardless of whether they are volatile or unusual. As long as it comes from your core business activity, it should be operating. But I mentioned MBAs, right? We'll come to that. The main business activity, it has some changes we need to look at. So Operating category will take all income, all expenses from your operations, right? Including your MBA, your main business activity. We'll see how it's going to change for entities like banks and insurance companies because they cannot follow this. They have a different business model altogether. Investing category, specifically, investment in associates, joint ventures, unconsolidated subsidiaries are all investing category. Any income or expense you make from cash or a cash equivalent is an investing category item. Any income and expense you make from an asset that generates a return individually and largely independently. For example, you are a business, you have investment property, you get rental income, it's invested. So clearly, you can't mix them with the other elements. Financing, what goes here? Income or expenses from your liabilities that relate to raising finance. For example, you go for a loan, the interest on the loan is financing expense, right? Or other elements that have effects on interest rate, other liabilities like a lease liability under IFRS 16. That lease liability is a financing expense, right? So you know the lease liability would have an interest or finance cost component. It clearly comes to financing category on the face of the income statement, right? So let's take note of this as well. So I mentioned main business activities. It's important because not everybody will have a P&L that looks like this. For example, a bank will not have revenue, cost of sales, gross profit. Banks don't deal in a business of this nature. They don't have cost of sales, right? So come to what should happen. So the concept of MBAs or main business activities was introduced, saying that for some entities, what would typically have been investing category for specified income and expenses, what would typically have been financing category for some income and expenses will now move to operating category. What do I mean here? So like I said, for some businesses, financing and investing activities are their main business activity. For example, a bank takes what deposits from customers and gives that out as loans. They are in the business of what? Money. So their operating income and expense is actually what somebody would have called financing. So you can't tell a bank to have that kind of classification. That's one example, right? So for these companies, they should include income and expenses in their operating profit that for other companies would have been investing or financing. I'll show you how the bank would look like, right? So you can see, like I said here, for operating category, investing and financing, they would have to move these things that would have been investing or financing to operating, right? Because of their business model. Let's take an example. This is a bank. Now, you know, a bank will have interest income, less interest expense, have their net interest income, fee and commission income, less fee and commission expense, will give you a net fee and commission income. Then you add net trading income, investment income, credit impairment losses, employee benefits. We are seeing all of these are operating. For another business, maybe you are a manufacturing business, you are a trading business, right? You may have had the normal operating, investing, finance, but for a bank, a lot of their business model is actually what? Financing and investing. Banks give loans, make money on their loans, pay what? Interest to their customers on their deposits sometimes, right? They invest in instruments like government bonds and make what? Income on that. All of those are typical investing financing, but for a bank, it becomes operating activity, right? Then they would have their non-main investment financing shown here, like share of profit in associates and ventures, and then interest on pension and lease liabilities, right? All of these would be shown separately, right? This is a bank. Let's see how it's going to look like for an insurance company. So if insurance is your main business activity, you would have something similar to the bank. So you have your insurance. So this would be like your gross premium, right? Then any insurance service expenses will show. So you can see for them they have a larger operating activity segment for their income and expense with a smaller investing or financing. Why? Because they are not like the general business. We can't apply that same model we applied for the general businesses to banks and insurance companies. So think about it like this. Despite the fact that we have that presentation for everybody else, the specific MBA would matter. You need to look at your main business activity. The main business activity will determine what is operating, what is investing, what is financing. So don't see it like everybody has to follow a particular thing. It depends on what you do, right? That is what will determine that, right? So I can pause for maybe just 2 questions. Keep them short. If not, I'll shift all questions to the end. Yeah. Any question? Yeah, Richmond.
MSL, thanks. I see you gave an overview of how the presentation will look like for profit businesses. Now, what about non-profit entities?
See it like this. If the IASB had to provide a sample for everybody, they'll never finish, right? Because how about government entities? Well, they'll be under IPSAS, right? Or entities that are commercial but are not applying, let's say, IPSAS, right? Or how about, let's see, these fintech companies? They don't have revenue cost of sales as well, right? So it all comes back to one question. What is your main business activity? So think about it for a non-profit entity, for example. Do they have revenue and cost of sales? No, right? So what will be operating, what will be investing, what will be financing? I don't think theirs will differ materially, if I'm being honest, from the general business, because there's no non-profit that does financing as their main business activity. They receive grants or donations and they spend on the activities, right? So they will probably follow the same operating, investing, financing. But the IASB did not have to give an example for every type of entity. That would have been too much work on their end, right? But yeah, in terms of guidance, let's not forget that accountants are able to apply judgment. So in those cases, you can apply judgments to determine what your MBA is in that case, right?
All right, sure. Thank you. So I'm guessing that auditors' fees will surely go up.
Yeah, I'm expecting that to slightly, but you can negotiate with your auditors, right? Okay, we can take one more question and then we move to the next part of the presentation. Any other question? If not, let's proceed. So operating expenses also have a particular rule on how you can present and disclose them. Let's start with the presentation and then we'll go to the disclosure. So first thing we need to note is that companies must present an analysis of the operating expenses on the face of the income statement. Under IFRS 18, nobody is permitted to disclose everything only in the notes. You can't say, oh, I have a few lines on the face of the P&L, everything else you can find in the notes. No, you must present some analysis on the face of the P&L, mandatory presentation. Don't push everything to the notes, right? You have 3 presentation options, really. You can either do presentation of expenses by function, by nature, or mixed. Mixed is new, right? They've given you the chance to use a mixture of function and nature classification. But there are some disclosure requirements. So if you decide to do presentation by function, then you have new disclosures in the notes. So extra work for accountants to do here. So function presentations where you do revenue, cost of sales, gross profit. Then the functions like what? R&D expenses, admin expenses, selling expenses, right? Marketing, like those functional expenses. If you do by nature, such as revenue, purchase of materials, transport costs, depreciation, employee costs, you are okay. So if you do by function, you need to do some further disclosure in the notes to show us how it would have been if you had done it by nature. Because investors want full transparency. Don't hide things under big headings that nobody knows what goes there, right? So looking at disclosure now, remember I said that if any operating expenses are presented by function on the face of the P&L, then new disclosures apply. What are these new disclosures? Comfort, please turn off your microphone. Okay. So you present a separate cost of sales line where relevant. So where relevant means that if you are not in the business where you have, let's say, inventory or a line on cost of sales, you don't have to. But if you do, we need to see cost of sales clearly stated, if you have it. Then you have to disclose a qualitative description of the nature of your expenses. You have done functional, but please show us the nature too, right? So you have a single note, so new disclosure requirements, right, by IFRS 18, a single note where you must disclose your specific information for 5 types of operating expenses. So the 5 are: show us depreciation, show us amortization, show us employee benefits, show us impairment losses or reversals, show us inventory write-downs or reversals, right? So this is how the note will look like. So I'll give you an example. Let's say the total depreciation for the period was 72 million, right? Show us the amount that you can find under cost of sales and admin expense and the R&D. So you are reconciling the nature to the function. So they wanted just 5 nature expenses: depreciation, amortization, employee benefits, impairment losses, and then what? Inventory write-down. So the relevant amount spread across the P&L under your function. Please spread everything else out here for us. We want to know, okay, how much of employee benefit is hidden in cost of goods sold, in admin expense? Are you paying somebody R&D expense and it's actually an employee benefit? Investors want to know, at least if you choose to go for what? The functional classification, then please give me a note that shows your nature. I hope it's clear. If you do nature, we are okay with you. If you do functional P&L presentation, then please, in your notes, give us a clear description of what? The nature too. So you want to reconcile them. But please take note that this is not intended to fully reconcile to the P&L, because here it'll capture both capitalized and expense amounts. So don't expect this note to be the same as the figures in the P&L. Some items may have been capitalized and will be on the balance sheet, for example. But we want to see, how did you spread everything out? Right. So remember, we need a presentation and reconciliation from functional to nature. I hope that's fine, right? Okay, so that is it for operating expense. Remember that you have 3 choices: mixed, functional, nature. If you go by functional, please give me additional disclosures reconciling nature to functional. That's fine, right? Let's come to the non-GAAP measures, right? Obviously, GAAP is generally accepted accounting principles, in case you don't know. So there are some non-GAAP measures and what we call the management defined performance measures, the MPMs. These are also required clearly. So which non-GAAP measures are now reported in the financials? So report only non-GAAP measures that are subtotals of income and expenses, right? Those are we call MPMs. We'll come to that. So subtotals of income and expense not required or specifically exempted by another IFRS. That is included in the company's public communication outside their financials. Measures that communicate management's view of their performance, right? And then the definition is narrow. Not everything is an MPM. For example, a non-financial performance measure is not an MPM, like customer satisfaction score. It's not an MPM. It's non-financial. It won't be in your financials. Or financial performance measures that are not subtotals of the P&L, like free cash flow. It's not an MPM, right? And then subtotals that are already in an IFRS, like gross profit. It's not an MPM. So it's already defined. It's not a subtotal. It's non-financial. It is not an MPM. So you don't have to stress with MPM disclosure, right? So certain non-GAAP measures that meet MPM definition will now be reported in the financials and audited. So your auditors will now have to express an opinion. If you include MPMs that deviate from it being true and fair, they can say, well, except for, when they give their opinion, except for this MPM, which does not follow this particular consistent definition, right? Remember, auditors have an extra thing to look at now. So let's break everything down. Performance measures could be financial and non-financial. Non-financial could be number of customers or subscribers, the store surface area in square kilometers or square meters or whatever, customer satisfaction score, your net promoter score. All of those are non-financial. They are outside the scope of MPMs. Then under financial, we have other measures that are not subtotals of income and expense: free cash flow, return on equity, net debt. These are not MPMs. Then those that are subtotals of income and expenses, the MPMs will be things like adjusted profit or loss, adjusted operating profit, adjusted EBITDA. You know, management may want to adjust because they want to take out a particular line to see the impact it would have had on financials. So it is management defined because management wants to communicate a particular message toward the users. There are some that are IFRS specified: operating profit before depreciation, amortization, and impairments. These are not MPMs. They are already in the standard. These may be MPMs. So under this, What are the new disclosures? You must disclose in a single note the following on MPMs. You have to reconcile the MPM to the most directly comparable subtotal. We know it is your own defined measure, right? But try and reconcile to the nearest IFRS equivalent. Show us what you did to the IFRS number to get the new one. I'll show you a real note, how it should look like. Explain how the MPM was calculated and how it provides useful information, all in a single note, by the way. Show us in a statement that the MPM provides management's view only and is not comparable to the MPM of other entities. Make it clear that your adjusted EBITDA is not the same as that of a competitor. So nobody should try and compare. You are telling the user that please don't compare, they are not the same. Explain and give reasons for changes to the MPMs, right? So what would a reconciliation look like typically? This is one. So you can see this is the IFRS subtotal. We have operating profit here, and we have adjusted operating profit. Tell me that, okay, I had impairment losses, restructuring expenses, subtracted gain on what? Disposal of PPE. So I wanted to show an adjusted operating profit without considering the effect of impairment losses. Could be under IFRS 9, restructuring expenses under your IAS 37 on provisions. You could also have what? Gain on disposal of PPE, IAS 16. I wanted a measure, an MPM, without the effect of these lines. Or profit from continuing operations. So I wanted my adjusted profit from continuing operations. So for example, if I had any discontinued operation from IFRS 5, I have to show the impact so that, okay, it is 32,100 under the pure IFRS profit, but if I adjust it, it's 39,908. Your user should be able to see what you added or subtracted. Remember, it's all about full transparency, full disclosure, right? Okay. Then another example of reconciliation, still in that single note, we want to see the tax and NCI effects. NCI means non-controlling interest. So show me the impact these MPMs would have on the tax figure and the NCI figure in the financials, right? So for example, here, if I have my operating profit and my adjusted operating profit, I'll show all the restructuring costs and any other line that has here. I have to break this down into the tax effect and the effect on non-controlling interest. Because your user should know, does it have any tax impact? Does it have any effect on those who are minority holders of the entity? We want to see all of that, right? Regarding the tax, there are three possible methods of computing the tax effect. You could use statutory rates in the jurisdiction. You could use a pro rata, current and deferred tax. It depends if there is such. You could also use any other method that gives you a more consistent presentation, right? But obviously, you need to disclose which one you went for the tax effects. This is quite technical, so we can't spend too much time on this, right? So that's it about MPMs. Remember, management-defined performance measures now need disclosure. Show me the difference between the IFRS estimate and then yours. And not everything is MPM. We saw that things like free cash flow, customer satisfaction score, those are not MPMs, right? So take note of that. Then aggregation and disaggregation. What can you aggregate, bring together? What can you disaggregate? So here, there is enhanced guidance on grouping information in the financials. So we have newly defined rules for the primary financials and the notes. We use what we call shared characteristics to group items. So are they similar by way of nature, function, size, geographical location, regulatory environment? You can use that to aggregate something or disaggregate them. Then a single dissimilar characteristic can lead to disaggregating if it's material. If they are not similar on a particular front and it's very material, you can use that to say, let's not present this line together, split them, don't lump them together, right? So we also have new disclosures that discourage companies from using the word other. So you hear things like other comprehensive income, other operating expenses. We are like, you know what? Stop the whole other. Nobody knows what is under the other. You know, for some companies, you see other operating expense, only to go to the notes and see the breakdown as other operating expense again. So how does the user know what is in that other? So we are being discouraged from using other. Unless clearly, right? you are unable to find a more informative label. If you've tried everything you can, you couldn't find a better expression than other income, other operating whatever, then go ahead and use it. So please take note, your auditors will probably start discouraging you. If you have a GL line, right, for other whatever, right, we will try and discourage you. Can we say something else apart from other this? It doesn't mean use things like sundry or miscellaneous as well, right? But yeah, take note of that. We are being discouraged from using other unless you can't find a better expression. So the newly defined rules, I wouldn't call them newly defined, but all they said is that the primary financial statements, balance sheet, P&L, comprehensive income, changes in equity, cash flow, these have a role to give us useful structured summaries of assets, liability, income, expenses, cash flows. Useful structured summaries, right? Then the notes are supposed to give us further material information. So you need to know where each one falls. What role does each one play, right? They just gave us this to clarify that in case you've forgotten the role these different financials play, this is what you're supposed to do. And don't forget that the notes are part of the financial statements. They're integral. In fact, there are no financials without notes. It's not a complete set of financial statements. So what are other changes applying to other IFRS and the other primary financial statements? I'll start with the most material one, IAS 7 on the cash flow statement. So operating profit or loss subtotal should be the starting point if you use the indirect method. You can't use profit before tax. You can't use loss before tax. You can't use profit for the year. Everybody relax, sit down. You must all now use operating profit or loss, which is what? A subtotal, right? So everybody starts from the same place when it comes to what? Preparing the cash flow. Don't forget, this has been well thought through because we said what will go into operating, investing, financing on the face of the P&L has been defined, right? So you get operating profit. So everybody's indirect method cash flow must start from what? Operating profit or loss. So we will not find that deviation in practice. Everybody will use one subtotal to start. The option where you could classify interest and dividend cash flow as either operating activity or whatever you wanted has been eliminated. This is something that IAS 7 has had for a number of years that US GAAP did not have, but now we are having a strict treatment. Interest and dividend cash flows, you can't make them operating activities. So let me summarize it for you. If you are an entity without a specified MBA, like the general businesses, manufacturing, sales, your business is general, right? For you, interest received is investing activity now, mandatory. You don't have the choice. Interest paid is financing. For accounting students here, take note. When you're preparing your cash flow, your console cash flow, right? You know you could put interest paid, dividend paid, under what? Operating. Now, strictly interest paid, dividend paid, they are financing activity outflows. Dividend received should be investing activity. But if you have a specified main business activity, like a bank, for example, there should be a single category for each line, operating, investing, or financing. So for a bank, you can't tell them they should put everything here in their cash flow. So it depends, right? But take note that businesses without any specified MBA, for them, this is a strict requirement. I think the biggest change we all need to take note of is interest paid, dividend paid, financing activity, right? Okay. Then, so this is how it will look like. Everybody starts with operating profit. Your interest received, dividend received becomes what? Investing activities now. Interest paid, dividend paid is under financing activities, clearly, right? Apart from that, the cash flow still stays the same. You have the same element. It still has 3 sections, but these are the material changes. If we go to earnings per share, IAS 33, what is changing here? You may wonder, what? Is something changing there too? Yes. So you are permitted to disclose additional amounts per share based on the alternative measures of earnings. So, typically we have basic and diluted earnings, right? You now have the chance to present additional measures of earnings. For example, EBITDA per share. You see, we have new subtotals, we have MPMs. You can use them to do anything per share. The numerator, right, can be one of 3 things. So you have your basic EPS, your diluted EPS, your numerator will either be a required income or expense total or subtotal. The ones that are required, operating profit, for example, right? You can use a common subtotal in the standard or an MPM disclosed by the entity. So we may have additional figures per share. Take note the denominator has not changed. The denominator will still be the weighted average number of shares as defined under IAS 33, right? So it depends if you are doing basic, it's attributable to what? Ordinary shareholders. Diluted, you bring in the impact of dilutive securities, convertible notes, warrants, share options, all of those things will come in. So the denominator has not changed. It's the numerator where you have the freedom to bring in extra measures, right? Balance sheet, what is changing? Only one thing is changing here. So not too much to learn or know if you're in practice. So on the balance sheet, it is now mandatory to present goodwill as a single line item on the balance sheet. So we want to see, not in a note, on the face of the financial, show us goodwill if you have it, right? Show us goodwill as a single separated line on the face of the balance sheet. So you see your PPE, intangible assets, let there be goodwill, right? This is something you see already in some entities, but some don't do it. So everybody who has goodwill must separately disclose goodwill on the face of the statement of financial position, right? Okay, how do you transition to and get ready for IFRS 18? First thing is it replaces IAS 1, like I said, completely. Next thing is it's effective 1st January 2027. Early application is permitted. If you want, you can start now, right? If you want to. So you can start preparing. Then it is applied retrospectively in accordance with IAS 8. So once again, take note, the name of IAS 8 is proposed to change. So IFRS 18 did not only change the standards we've looked at so far. So IAS 8 is currently called accounting policies, changes in accounting estimates, and errors. Its name now will be basis for preparation of financial statements. Proposed name change by IFRS 18, right? So take note of that. It has changed and even changed the name of IAS 8, right? Okay. In your first year of applying IFRS 18, you need to disclose specific reconciliations required between the old IAS 1 presentation and the IFRS 18. So you may have to show, don't just prepare for this year. You know you're supposed to show comparatives, right? So for 2024, you show 24 and 23. So if you apply, let's say early in 24, show me the impact on 23. So I need to see 23 kind of restated under IFRS 18. So this is why I'm saying maybe your auditors want to charge you more for the extra work, doing all those reconciliations, and also audit fees or account preparation fees may slightly go up. It depends on who does your preparation for you. So take note of all of this. These are very important transitional requirements that we need to be familiar with, right? So that is about it. This has captured the essential must-knows, no matter who you are. This covers pretty much 95% of the standard. There are a few things like the impact on IAS 34, specific industry requirements, but if you can go through this or you've sat through this, you are fully updated on IFRS 18. I'll bring the presentation to a close here. If there are any questions, the floor is open, right? So I'll take questions now. Any question from the audience? Any question? Any question? Yeah, Bernard.
Yeah, good morning, Mike, and good morning, everyone.
Yeah.
So I want to find out, so in practice, we have to start renaming our ledgers. Yeah.
Okay,
Since we,
okay, go ahead.
yeah, I think I'm cool.
Okay, so renaming ledgers is not something the standard has said upfront you should do. All you need to do is whatever it is called in your books is fine, because you know your investors or the users will not see your ledger details, right? So just make sure that you do a proper mapping so that even an auditor will understand. So you may have to rename some that are ambiguous. For example, if you have other expenses or other something ledgers, then the question is, okay, what happens to your auditor? Would you always have to explain to them or you change the name in the ledgers? But the key thing is that at the end of the day, when it's making its way to the financial statement, you have to follow IFRS 18. You know, they don't want to be too intrusive to tell you what you should name it in your ledger. But once it gets on the financial statement face, then you must follow IFRS 18. So I would say it depends on what you've named your ledgers, but it's not too important like the final output, right? Okay. Any other question? Any other question? Any other question? Any question? Any question?
Mike, I think someone asked how in the comments box how it affects those applying IFRS for SMEs.
Okay, so SMEs, as you know, they have their own chapters regarding specific IFRS. So yeah, they'll have their own requirements clearly shown. You know, they are not required to apply full IFRS, right? So they'll have their own requirements provided separately, right? So they are not required to strictly follow this unless the IASB clarifies on that as well. Right. Okay, so I'll take there are no further questions. We made it within an hour. Yeah, so if there are no further questions, then I would say enjoy the rest of your day. This is recorded, so it will be on our YouTube channel. You can just catch up on that. Yeah, Isaac?
Okay, I wanted to know the perspective rate. How many years back?
Yeah, your voice is very low, so I don't know if you can get closer to your microphone. Isaac? Okay, I'm not sure I can hear you. Any other question?
Hello.
Yeah, it's better now. Go ahead.
Okay, so I was saying on the retrospective page, how many years back?
You don't need to go years back. What is presented on the face of the financials? So earliest comparative, same rule in IAS 8. So earliest available information, right? So you don't have to go back 5 years, 10 years. No, what is the earliest presented one? Same rules in the IAS 8, right? Yeah. And Michael? Michael, you're muted if you are speaking.
Sorry.
Yes, Wilfred.
Since this is the free one, so I'm sure that's why you rush to give us the overview. When we have the paid version where you take your time and go into the details.
Okay, when I was thinking about IFRS 18, I didn't plan to have a paid version. To be honest, I've not thought about it. You are the one giving me ideas. It was just to share what I've read about the standard with everybody else. But I don't know, would there be a paid version? I'm not sure. But I mean, yeah, I don't know. We'll see. But I didn't think about it till you asked. So I don't know. Yeah. You could have a follow-up again free. These are standards. I don't know, but yeah, I've not thought about it. Richmond?
Yes, MSL. So I wanted to know, given this new standard, would there be a need to make any adjustments if there is to general internal control and internal audit practice? Would it pose any change?
Yeah, I think the key thing will be around MPMs, right? So you have your own defined measures internally. Just make sure your MPMs comply with IFRS 18's rules on MPMs. Subtotals, make sure what feeds into the subtotals, you capture the right data. So it's really about restructuring your journals, your ERP systems to fit IFRS 18. But I don't see it having like sweeping impact on how business is done. Like you still sell the goods the way you sell them, just that the way you report them should follow a certain format, right? So I think minor adjustments, it won't be as major as earlier standards like IFRS 16, for example, right? So yeah, it's all about presentation, really.
Okay, and a follow-up. You mentioned that mandatory application of this standard is, I think, 1st January 2027.
Yeah.
In your experience or in your encounter, have you by chance seen any firm that has started an early adoption? And if you have, what benefits or challenges have you teased out from those who have implemented it early?
Okay, so this standard was issued in April this year. How many months ago? Like 2?
Oh, okay.
Yeah, it's fairly new. So if anything, it's from like 24 financials prepared in 25 that will see people trying to apply. But I can bet you the big entities are already doing implementation, like they've set up teams doing transitional provisions, analysis of the financials. Yeah. But for now, people are just studying the impact. So we'll see a lot more of it early next year when people are preparing like their 24 financials. Right. But in Ghana, most of wait till it's mandatory. So yeah. So that, yeah.
Many of us don't have the budget to constitute those internal teams to look at.
Yeah, it's fine. You can wait for 27, so that's fine. Just remember that when you wait, you have to still do what the retrospective application. So, yeah.
All right. Thanks.
Okay. All right. Any other question? Any other question? All right, I'll take it that there are no further questions. I hope not.
I kindly mentioned that if you could tell us a little bit more about MSL Business School, what you do, how it goes in the chat box. Thank you.
Oh, I think I missed that as well. Okay, so, what do we even do? All right, so we are a leading technology-driven provider of education to potential business leaders and current business leaders. So we offer tuition for ICAG if you are sitting the Chartered Accountancy exam, CIT Ghana qualification. Currently, we have plans to introduce other professional programs, but for now it's ICA, CIT. I think the key thing is we are tech-driven. We try to do everything based on technology and innovation, and our faculty is made up of experienced people from industry, right? So yeah, myself and every other person who lectures has practical experience from industry. So yeah, I think I'll just leave you with the words tech-driven. I forgot the leading. So leading tech-driven, right? Training for all professionals, right? So yeah, we'll probably have a lot more of these webinars in the coming months, right? Yeah, so I think high level, that's about it. But you can read about us on our website, social media, and all. Yeah. Yeah, Isaac?
Hello, sir. Thank you. This follow up to my earlier question. You said the slides will not be shared by a recording. So would it be shared through the mail that we provided? Or we have to go to YouTube?
Exactly. It'll be on YouTube. It'll be on YouTube. So just subscribe to the channel and probably turn on notifications. It will be done maybe tomorrow or later today. It depends on when we are done with processing and all of that. Yeah, but it will be on YouTube for sure. And we'll probably share the link to the YouTube on all of these platforms. You can also check anywhere you follow us, you see it. Yeah.
Do you develop software for companies?
You are giving me business ideas. We don't do it yet, but we can do it. What kind of software do you want?
Okay, we are a manufacturing company in the metal, and then like we manufacture aluminum products like kitchenwares, cooking utensils in the house, and it's a manufacturing company. We are in Tema, and I'm the accountant, and I've been tasked to get an accounting software or a software that can be used by all the various functional departments. So HR, marketing, accounting, production, something like that. If you can develop something for our company.
Okay.
Currently, I use Excel for everything and a lot of manual things, but I've been tasked to get an accounting software for the company.
No problem. So the email we sent you the link on, right? Just send an email on that. And there are free versions you could recommend. So I'll share the free ones with you first. If you can't afford, if you can afford and have the budget, then I'll also recommend maybe some developers who can help you make your own software.
Okay, but so I should send you a mail, eh?
Yes. Respond to the link that we share the link on here.
Okay, sir. Thank you.
Okay. Richmond?
Yes. The last one, I forgot the last question. But anyway, I like your Gamma Lizard you did to Isaac's suggestion. But anyway, with all that said, a key to us, we accountants, right? A key to all this to make us more efficient to definitely have to be the accounting system that we use. And as Isaac was saying, he's doing a lot of Excel, but some of us are doing using an accounting system. But my main concern is with the solutions that are developed by local entities. I can bet that the big ERPs like SAP and the SAP, they would have teams that will definitely look at these changing standards and then do some updates to their system to allow this thing to be done easily. My question is, so for some of us who are using the local alternatives, who are very slow to bring updates that incorporate these changes to make our work easier, what is your best advice?
Okay, so there are two things you could do. One will cost you no money, the other will cost you money. The free option is you have learned about IFRS 18, so you have to teach the developers what they should change. That is free. It won't cost you any money. It will just cost you time. The second option is to get someone to train them on how to do it. If you want to pay me, you can reach out. We'll train them on specifics they need to focus on, right? But since you've listened to me, you can save money and train them yourself, right? But if you think you need help, reach out to me or any of the big four firms. Any accounting firm really can train them on that. Because don't forget, the system is as good as the input. So if you don't tell them what has changed, as a developer, they only know writing code, right? So tell them, okay, change this one to give an output of this in your code. Let your code pick maybe the database or the SQL, whatever they are using, should pick from this and this and this and that and add them together, right? So it's your input that they'll use to develop. So either you train them yourself or you can pay someone to do that for you, yeah.
All right, sure. Thank you very much. I really appreciate it.
All right, so I'll take that. No further questions, right? So enjoy the rest of your day, and we'll probably catch you on our next webinar, right? Have a lovely day, everyone, and bye for now.
Bye.
Thank you.
Bye.
Thank you.
Thank you.